be liquid. Be liquid. If I'm right that we're finally going to get the recession that never came in 2022 and 2023, the financial markets across the board are only priced. I mean, they've done some work, but they're only priced 25% of the way for a recession. And I think that we're going to be getting an economic recession. I know that it's the boy who cried wolf, but remember that the wolf shows up at the end of the story. Have the liquidity. Have the liquidity so that when the assets get transferred from the weak hands to the strong hands, that you're one of the ones that has the strong hands.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. As worldwide tariff uncertainty persists and U.S.-China tensions continue to escalate, are President Trump's trade policies speeding the economy into recession? For guidance, we turn to highly respected economist and award-winning researcher David Rosenberg, founder and president of Rosenberg Research. David, thank you so much for joining us today.
Pleasure, and thanks for having me on.
David, it's always a pleasure. This is an important day to have you on for a whole variety of reasons, but first and foremost, it is election day in Canada, and I very much appreciate you taking yourself away from monitoring those results to speak with us live.
Well, it's a good thing that I pre-voted, so you have my full attention.
I appreciate that. And look, I do want to get to this whole topic about the Trump tariffs and all the knock-on effects of that, but I guess very quickly, any key thoughts about Canada before we know the outcome of today's election?
Well, it was a dramatic turnaround because it was just a few months ago that the Conservatives had something like a 25 percentage point lead over the Liberals. And going into the election, in fact, for the better part of the past month or two, really since Mark Carney got the Liberal nomination, the polls have been consistent with the Liberals with a modest, call it 3 to 5 percentage point lead. But, in Canada, being a parliamentary system, the Liberal vote, riding by riding, is just more efficient than the Conservatives. So it looks as though, and we'll get the results tonight, obviously, that the Liberals are going to emerge with a majority government. I guess that if you're looking for stability, better a majority Liberal government than what we had in the last go-around, where the Liberals had a minority and were supported by the left-leaning New Democratic Party. So it looks as though that's what we're going to get. And I guess the good news is that a Liberal majority is already priced into the market. So we're in this phase globally where no surprise is a good surprise.
Look, I let me know if it's unfair to ask you political questions here, because you're an economic researcher, not necessarily a political one. But I am curious because those of us watching from the cheap seats here in the U.S. Did see that big shift in probability of who was going to win the election. That after Trudeau, announced he was going to step down, Poilievre really, had a kind of a commanding lead in the polls. Is the swing back to the Liberals because Carney's such an appealing candidate to them? Is it because Trump drove the Canadian populace into the Liberals' arms by, his comments about the 51st state and the trade tensions between our countries? Because Poilievre was sort of looked at as sort of having a similar sort of Canada First platform like Trump's America First platform. And I'm just wondering, just as Trump may have really, shaken up the chessboard geopolitically, did he actually shake up the chessboard at all in the actual Canadian elections?
100%. I think there were two really big events. The first, of course, in December when Justin Trudeau resigned. I think that you're right about Mark Carney flashing those credentials as being a central banker, and not just a central banker, but also really a global policymaker, and is viewed by a lot of folks as having the gravitas and the panache to talk trade and economics with the administration. No, I think that a good part of this is that the New Democratic Party, which is the Socialist Party in Canada, the big move has been in their support. Their support has nosedived. It's gone in the polls from their traditional 20% to something closer to 7 or 8. They might not even be an official party after today.
Wow.
And so all that 12 to 13 percentage points went from the NDP to the Liberals. So it's not even as if you can say that, that the hard conservative support really diminished. You could say at the margin a couple of percentage points, but all that NDP support went to the Liberals. And the question is why? And the answer is because a lot of those NDPers, and a lot of them feel at home with the Liberal Party. The Liberal Party, this is not the Liberal Party of Jean Chrétien and Paul Martin of the 1990s, which would have been almost like a Bill Clinton, Bob Rubin type of Democrat Party back in the 1990s.
Okay.
So you could say center, right of center. And then under Justin Trudeau, it moved really to the left of center and was propped up by the New Democrats. The New Democrats, that 12, 13 percentage points that moved to the Liberals, um, was a strategic move amongst these people to park their vote the Liberals because they'll never vote conservative to begin with. It's just too business friendly and too right of center. But they want to make sure that the Liberals win a majority. So when I say strategic, they want the Liberals to win a majority because they feel, the NDP feels, that the Carney, the Liberals will in fact be much more effective in taking Donald Trump head on. I don't know how much time you want to spend on this, but the reality is that neither Carney nor Pierre Poilievre, the leader of the Conservatives, have ever even met Donald Trump. Of course, we know that Carney has spoken to him on the phone, but they never met him. And to me, it's unknown as to who would be, the better leader to deal with all these intense trade issues with Donald Trump and with the administration. Uh, but I think that Canadians seem to be more favoring the person with the dossier and who was head of the Bank Canada, then head of the Bank of England, and then more recently vice chairman of Brookfield Properties, a renowned and respected multinational corporation headquartered in Toronto. So he's got that dossier as being a globalist. And in Canada, a globalist is not a derogatory term
Hmm.
against Pierre Poilievre, who does have a lot of respect, but is a lifelong politician. So I think that's what this really came down to. I think Trudeau resigning was a very big deal. He was actually ultimately forced to resign after his finance minister, Chrystia Freeland, resigned because she was in the process of being demoted. So that was a big inflection point. But I think that there is this view, yes, did Donald Trump manage to spin the dial in Canada's election? 100%. Because when you looked at the debates and you looked at the party platforms and you looked at all the commercials, it was all about Donald Trump. It's as if in Canada we were living through the November 5th US election all over again. So it was as if everybody is running against Donald Trump. And the Liberals seem to have won that battle. I'm saying this, of course, before the polls have closed. But certainly in the general public polling, and they were all very consistent, the view is that the Liberals under Mark Carney were better equipped to deal with Donald Trump. But that's all front page news in Canada. It was not exclusively, but I'd say 80% this election in Canada was all about who is going to deal with this chaotic and erratic White House.
Okay. Well, look, if we've got time near the end of this discussion, I would like to return to this and just get a sense for what you think let's assume Carney wins, what you think the dynamics will be like between Canada and the US going forward from here, now knowing the players. But before we get there, let's jump up to a higher level. So in my intro here, I asked the question, is the uncertainty that's persisting around the tariffs, is that serving as an accelerator for the economy towards recession? And I specifically picked that question for interviewing you because I've been reading a lot of your recent work, David, and I get the sense that you think the answer to that might be yes. So why don't we start there? And I guess on your way to that answering that question, just in general, what do you think of the Trump administration's economic policies so far?
Well, the economic policies so far have been a huge disappointment. And, I guess we could debate as to what some of the successes have been uh, in some areas of foreign policy, although some of that still remains to be seen. Um, the border seems more secure. Immigration, of course, the Doge file has had its impediments, but I don't think anybody was ever going to argue about Washington eradicating fraud and abuse and waste. Perhaps we could talk about how it was all executed. And the same with the trade and tariff file about how it's all being executed in such a, throw spaghetti against the wall and see what sticks. So it's created this chaotic environment, for the business sector in terms of your question. We all know that starting in 1987, Donald Trump, the real estate mogul back then, was talking openly and voraciously about how America was being ripped off. This is all the way back to the mid 1980s.
Right.
So the word tariff was always his favorite word. America, despite its economic supremacy and American exceptionalism, it didn't matter. America, in Donald Trump's views, and of course, a lot of his supporters, that the US is always getting ripped off by its trading partners. So this was part and parcel of Trump 1.0. Trump 1.0, though, the tariffs came, but were really targeted to some countries. They were targeted to some particular items, whether it was solar panels or washing machines or refrigerators. The big fight with China back then, was over soybeans, if you remember. Uh, and I think that a lot of us thought that, okay, well, Trump 2.0, of course, tariff and trade is going to be back on there, but to what extent? Because when you take a look at the polls going into the November election, what was first and foremost on Americans' minds were not trade and tariffs. They were the cost of living, immigration and the border, healthcare, and education. When you're taking a look at the list of items top of mind for the voter, uh, tariffs and trade were right near the bottom. So the fact that the administration has made this their top economic policy, I mean, what happened to the deregulation? You hardly see any of it. What happened to drill baby drill? So, or even the fiscal side, like saving the economy from falling off the fiscal cliff by the end of the year, if those 2017 tax revisions manage to sunset, we're going to have a really horrible recession, not just this year, but next year. And I think that's what people were thinking he was going to spend his time on. But the president has just gone full bore on this tariff and trade situation and has made it the centerpiece right now of his economic strategy. So, in answer to the second part of your question, I guess I'm a bit surprised that he has gone all in on this strategy right now. And I think this will put at risk his fiscal policy and maybe put at risk next year's midterm elections.
All right. And sorry to interrupt, but just are you surprised by the strategy or are you surprised by the timing of the strategy that he did it this early?
Both. Well, I'm surprised at the timing. I would have made the pro-growth aspect of his policy first. I would have made fiscal policy first. I would have put ensuring that all the 2017 tax revisions get extended first and foremost. I would have gone much heavier on the deregulation file, I would have gone much heavier on the energy file. And you see, this is why he was successful in his first term. Now, he didn't win his second term in 2020, but something called COVID got in the way. And Joe Biden managed to win the election by campaigning in his basement. But up until COVID, the economic record of Trump 1.0 was actually pretty good. But what did he focus on? First, he focused on tax relief and he focused on deregulation. And then it was later on in his term, call it mostly in 2019, where he focused on trade and tariffs. Again, they were select. They were not broadly based like they are right now. So he did all the pro-growth stuff first. And there's no doubt that the tariffs and the trade frictions of 2019 was an impediment to growth. We did have in the second half of 2019, we did have a capital spending recession. We actually had an industrial sector recession. That's why the Fed was cutting rates. Remember, the Fed went into 2019 pledging to hike rates twice. They cut rates 3 times because the economy went squishy soft in the second half of the year, but you see the consumer hung it together. And the consumer hung it together because it was still feeding off the previous tax cuts, which were significant. This time around, he's doing everything backwards. And he's starting off with the anti-economic growth agenda. And frankly, I don't know who he's listening to. Maybe he feels that he's got to get this done in his first 2 years or it won't get done at all. But then again, none of this is coming through legislation. President Trump is operating almost exclusively or exclusively on this issue through executive order and a loophole on national security from an arcane trade law that was passed in 1962 during the Cold War. So I would say that I'm surprised at the timing, and I'm also surprised that at the extent. I mean, April the 2nd, Liberation Day. Yeah, I called it liberation. Liberate us from sanity. I mean, what was that? I mean, first we're going to have 10%. The U.S. is going to take its average tariff rate from 2.5% to 10. But then he introduces reciprocal. And his second favorite word after tariff was reciprocal. And he just talked about reciprocal, reciprocal, reciprocal. And April the 2nd was an actual disaster because what all those different numbers, 30% extra tariff rate to this country, 40% to this one, 50% to this one. And what they had done, and I'm not even sure the president understood these numbers. I think his staff gave him these numbers. These numbers were just basically each individual country, and there's hundreds, how many countries are we talking about? Each number was different. Why? Because those numbers were quotients. They were basically the trade surplus that country X had against the United States divided by those countries' exports to the United States. The trade surplus divided by exports was their reciprocal tariff. So what Donald Trump was telling us on April the 2nd, when you look at the hidden message, and maybe it's not so hidden, was his desire. These numbers reflected a desire and aim to obliterate all bilateral surpluses that other countries have with the United States. And of course, then we had the market reaction. The president's telling us, and Lutnick is telling us, and Besson's telling us that we're not looking at Wall Street. We're not looking at the stock market. But then they tell us, well, we're looking at the bond market. But they were looking at the markets in general because we were just within a couple of days of a true freeze up. We're talking about a potential repeat of 08 and 09. Different reasons, but the credit markets in particular were starting to freeze up. There was no investment grade issuance, no high yield bond issuance. Everything just froze up. The stock market was in free fall. The most economic sensitive sectors of the stock market were down 25 to 30%. So you can say, well, I'm not looking at the stock market, but it's like saying I'm not looking at the economy because the stock market was giving you a certain verdict of what this is all going to mean for the economy. So then everything that's happened since, and you mentioned that. So then, just like with Canada and Mexico, we're going to have these 25% tariffs, then we're going to have carve-outs, and we're going to have a reprieve, and then we're going to have these reciprocal tariffs. Oh, then we're going to have a reprieve, and then we're going to do trade deals. And you just don't know what to believe, because there was a span there over a 2-week period where there was 18 different announcements coming out of the White House in terms of changes to what was already previously announced. So as an investor or as a business person, how do you plan? How do you plan in this environment of heightened uncertainty? Now, people will say, well, life is uncertain. Things are always uncertain. Yeah, I realize that. But, there are measures. There are measures of economic uncertainty that go back decades. And you can model out economic uncertainty, because we're talking here, Adam, about a 5 standard deviation event. If you're taking a look at the measures of uncertainty, it looks like a dot-com stock in 1999. It has just gone vertical up. I mean, we just got the Fed's beige book last week. The word uncertainty showed up in a 50-page document about 100 times. And we never saw anything like this in Trump 1.0. And so the uncertainty, what does uncertainty do? How do you model uncertainty? The first economist that modeled uncertainty was John Maynard Keynes. Now, how do you model uncertainty? It's behavioral. But everything about economics, which is a social science, is about behavior. Spending behavior, investing behavior. And it's no different really than, I think the best analogy anybody gave was Jay Powell, who in December talked about, well, what is it like for a central banker in this chaotic environment? Is akin to being in a dark room with furniture. And what do? You stand still, you don't move, so you don't trip up. You extend that analogy to the economy. What do you do in a period of high and rising uncertainty? Is you freeze up. Businesses freeze their CapEx plans, which you're seeing in all the data. Of course, the Fed's talking about the soft survey data, and they're waiting for it to show up in the hard data. The problem for the Fed is that when it shows up in the hard data, it's too late. We're in a recession, and they'll be scrambling, just as they did in the second half of 2019. But I think they'll be scrambling a lot harder this time around. Businesses freeze up CapEx. There's not a business that's going to be committing long duration capital in an environment where they don't have any policy clarity whatsoever. So businesses focus on their balance sheets, they focus on liquidity, and that comes at the expense of capital spending, which feeds directly into GDP. What do households do in a period of high and rising uncertainty? Now, I cannot believe all the people just going nuts over the latest retail sales number. You're seeing a massive increase in retail sales on goods ahead of the tariffs, because people know that those prices are going to be going up. So we're front running all the expenditures. That's going to create an enormous vacuum in the spending data in the second half of the year. But what is the normal reaction when you model this out in terms of the household sector? Not much different than the business sector. You freeze up. You don't spend. You focus on raising your precautionary savings rate at the expense of discretionary spending. And that's what the macro theme is going to be from here until we get some semblance of clarity, beyond just telling us, what deals are being negotiated right now. So you're going to get a freeze up in household spending, in CapEx, in hiring intentions. And I think to some extent the damage has already been done. So that's what uncertainty does. We modeled this out in classic John Maynard Keynes fashion, and found that just the uncertainty alone, not even including the direct impact of the negative trade action, because we don't know what that's ultimately going to look like, especially with China, which is the elephant in the room. Just the uncertainty alone and the impact that has on the savings spending relationship would be enough to drag real GDP growth down by between 1 and 2 percentage points from the counterfactual baseline growth, which is right now running just over 2%. And that's how just the uncertainty alone causes virtual economic stagnation. You might say, well, that's not the colloquial classic back-to-back quarters of negative real GDP. That much is true. But when you have flat growth and ongoing increases in the labor force, that drives the unemployment rate higher. That creates more excess slack in the labor market. That ultimately leads to weaker nominal wages. And that then leads to lower consumer spending. And that's where things get really complicated. All these second order impacts. I'm glad you led off with the indirect impacts of the uncertainty, because a lot of people don't recognize just how damaging that is to the economy on its own, irrespective of what we're going to get the real damage if these tariffs ultimately do go through as is.
All right. So, David, do you think then it sort of sounds like you think that the damage has already been done? I guess the question um, is this progression, this knock-on, second order effects, that sort of cascading progression you described, is that pretty much baked in at this point?
Well, it's difficult because trust is something that's very difficult to build over time, but it's very easy to lose. And I think the White House has lost a lot of trust because you just don't know what's going to change. Something announced on Monday is going to change on Wednesday. You have these tariffs being announced. They seem to be cast in stone. 2 days later, there's carve-outs. 2 days later, there's reprieves. What do the reprieves even mean? You got the situation where you had this attack on Jay Powell. Not just attack on Jay Powell. We've seen presidents pressure central bankers before. The famous story of LBJ pinning McChesney Martin up against the wall. Okay. We had a situation where we know that Richard Nixon gave Arthur Burns a nervous breakdown. But I don't think anybody, and this is, of course, the blessing and the curse of social media, when you just have to basically put stuff on or just call a press conference in the White House, that you would basically threaten to fire the head of the Federal Reserve. Okay, that really happens in less developed countries, unstable, so even the notion that the president was going to fire, and then you had some of his officials say, and I think it was Kevin Hassett say that they even had a search committee. Think about that. And then is it a day later? Because I think the markets puked that day. Oh, but we're not looking at the markets. And then the next day, the president says, I was never going to fire him. The media took that story. And I'm there thinking, okay, like, what planet am I from? Like, what's going on here? So trust is lost pretty easily. So now we don't know from one day to the next, 1 week to the next, what's coming out of this White House and what's going to change. So you're just not going to do anything because you just don't know. And so that's what I'm talking about. The interesting thing is that, we were told in Trump 1.0 to take the president seriously, but not literally. And then up until April the 2nd with reciprocal, we were told, well, we got to take him seriously and literally. And now here we are almost a month later thinking, do we take him seriously or literally at all? I mean, you can't make this stuff up. That basically, think about it, but think about what do you do as an investor? I think that right now the markets are bobbing around. It's all machines and algos and technicals. What portfolio manager or CIO is doing anything right now? We had the president basically, I tried to keep an open mind. When we wrote our reports comparing the Harris campaign to the Trump campaign last fall, head and shoulders, the markets and the economy came out ahead with the Trump campaign, but we were not expecting such a sloppy implementation. Especially, we did not anticipate trade and tariffs are going to be first and foremost. Okay, we're going to go on attack on global trade for the greater good. Okay, we thought that that would come later, and we didn't think it was going to create such havoc and such uncertainty. And what's interesting is that, in Trump's first term, it was his White House that was a turnstile. His White House was chaotic, but the world was pretty stable. And now in Trump 2.0, the White House is stable, and it's the rest of the world that's gone chaotic.
Right.
So
Right.
we just flipped everything on its head. But it's hard to know what the answer is. We're here, and we're told that there's a press conference or there's an interview, and President Trump says, "Yeah, we're talking to the Chinese." I just saw Scott Besson today. He was on TV, and he's squirming, and admitting that he knows nothing about any discussions with the Chinese. But you see, just saying we're in talks with the Chinese, that's going to get you 1,000 points on the Dow. But it's like the boy who cried wolf. I mean, there is diminishing marginal utility to keep saying that when the Chinese are saying there are no discussions taking place. But we knew there, and at what level discussions, because we're being told there's discussions the same day or the same week that Xi Jinping is going on this Southeast Asia junket, because he's inking his own deals. So I don't know what's going to end this uncertainty. I think that, I'd
Yeah.
like to say that the midterms next year could end it, but we're seeing policy being implemented through executive order, not through legislation. Or maybe it's 2028 elections. I don't know. I don't know. This is basically instability and uncertainty. And I really don't intend a bit to piss off the legions of Trump supporters out there. You would have counted me as one of them. Last year, we put a report saying Trump's policies are actually going to be much more beneficial for the investor and for the economy. But it's not turning out that way. Not that we know whatever Kamala Harris would have done. We have no idea how that would have turned out. However, we know how this is turning out. And
Yeah.
it's just, I think, more the sloppy implementation. I think it's the really inconsistencies that we're seeing, changes every week or every second day, like I said before. How does a market economy, an economy that is really driven by risk appetite, what is happening to risk? So Adam, I pose the question back to you. How does an investor or how does a business person take on risk? There's nothing wrong. Risk is not a dirty four-letter word. Okay. The question is, you have to be able to estimate the risk, calculate the risk, price out the risk. You don't, but right now we're in risk avoidance. And for an investor, what does it mean? It means that risk premia. Now we're going to have these periods where things get oversold, things snap back. And you've seen that in the stock market, seen that in the credit market. But this is an environment where risk premia across all the asset classes widen. And it will continue to widen until we get some clarity. And especially in the China-US situation, it'll be a case of who blinks first. We'll have to wait for that Khrushchev-Kennedy moment when somebody's going to have to blink first. Because you're talking here, I mean, it's one thing, we're talking about global trade is like a $33 trillion animal. You know what people talk about globalization today, though it's a filthy word. But it is what it is. It's a $33 trillion animal. Globalization, global trade is bigger than the US economy is. It's a third of global GDP. And that $33 trillion is under attack. But now the focus has shifted as we're seeing all these stories about side deals, and Canada and Mexico largely got spared, but not entirely spared. And we're hearing all sorts of stories, all in an attempt to do a quick renegotiation of the USMCA. And that's what I mean. We're just really operating every day on stories and narratives and innuendo. But the US-China relationship is a $600 billion economic relationship. And now this is what the new story is that there's been this ongoing economic war been going on for years between the US and China, but now it's hit a real crescendo. And we have a real situation here where, you can say on the one hand, well, these Chinese producers flooding America with cheap goods, displacing American workers, although is that what does US want to go back to Appalachia? America is a sophisticated service sector driven economy, medical services, financial services, technology services, entertainment services. But I guess there's some segments that want to go back to, to textile factories in the South. I'm not so sure that's very good economics, but for the here and now, all that stuff, and this is what's going to happen in the next few months. You see, we haven't seen this yet. And we've not seen what happens when the shelves at Walmart and Target are bare.
Right.
You want to go buy some clothes for your kids? Good luck. You want to go buy some toys for your kids? Good luck. And then when those tariffs really hit Mexico, when you consider that the United States imports $230 billion of food, and avocados come from Mexico, and so does a lot of produce. Anyway, that's something that we haven't seen yet. The economy's been kept alive because you had a lot of the pre-ordering and the pre-buying ahead of the tariffs. I said before, that's going to create a serious vacuum in the economy in the second half of the year. But on top of that, if all this stuff goes through, and I don't believe that we're going to be seeing a tremendous number of trade deals. Maybe this will be the trade deals, which I think is I don't know what we want to call them. Maybe this will be an about face. I'm not sure. Maybe maybe the president walks back everything and manages to say, I got a few deals. I'm a deal guy. We'll see. Maybe that's what comes out of this, is that this was all basically for naught. We tried to do this. We said we don't listen to the markets. Oops, no, we listen to the markets. Markets told us, no, don't do this. And we find a way to walk it back. But then what happens? Adam? You're trying to stay ahead of the curve in all this. What's next on the agenda is this big, beautiful bill, the fiscal bill. And all of a sudden, if Donald Trump did all this for naught and just created all this havoc and volatility and uncertainty and then walks it back, he would have expended a lot of capital in Congress. And you got these Freedom Caucus members in the House. They're not so thrilled with the big, beautiful bill. So when you're asking me we're playing a game of dominoes here. Every action has an equal and opposite reaction. As we invoke Sir Isaac Newton's laws of motion. This then could impair the ability to get through the fiscal side, which could remain in a state of disarray. And that'll be the next round of uncertainty that we'll have to deal with on top of everything else, because it's all connected. It's all about politics. But a lot of the success that Donald Trump was going to have in Congress was because he had a lot of the tough arch conservatives in the House scared that they would be primaried if they dared vote against the big, beautiful bill. Well, if you noticed what's happened to the president's approval ratings across the board, have taken a nosedive, and especially his handling of the economy. So all of a sudden, considering just how thin, they don't have a lot of maneuvering room in the House. So then this is going to come down to what it means for a new source of uncertainty that we're going to be facing that nobody's talking about right now because we're living in the moment and the here and now on trade and tariffs, is going to be fiscal uncertainty. That's going to be dominant in the second half of the year.
All right. So these are the dots I'm connecting listening to you, David, here, which is, you're saying, look, uncertainty breeds a conservative response, or an entrenching response amongst corporate capital allocators, households, et cetera, right? You get more spooked, your fiscal sphincter tightens, right? And the longer we're in a period of uncertainty, the less spending gets done. So it sort of has this corrosive effect on future economic growth prospects, right? So how long are we going to be in this period of uncertainty? We don't know yet, but every day it goes on, that corrosiveness builds, right? Now, I heard you say that trust is, takes a long time to build and it's easily lost. So to me, listening to you, there's going to have to be, it sounds to me, I get the impression that it's going to be difficult in your eyes to see Wall Street pivot on a dime on any announcement that's positive and say, oh, okay, well, forget everything that we were worried about. Now we're back all in, right? It's going to take time for those financial sphincters to start to unclench here. In the interim, we're going to have an air pocket coming out of all the front running of demand that happened in Q1. And there's additional potential risks here, right? Like if this thing does turn out to be a misadventure, it's going to lead to a loss of political capital, and Trump's going to have a harder time getting his other economic policies pushed through Congress. So, unless there's something really huge, China and the U.S. announced tomorrow, that they've made up and everybody's friends again. It's probably going to take us a long time to get out of this period of uncertainty, is what I'm taking away from you. So that then gets me to the so what. Okay, does that mean that risk of recession is higher? I think that's more or less what you were saying earlier. But I want to kind of give people a sense of what to prepare for here, right? Should they be preparing given this period of toxic or corrosive uncertainty that we're in? Should they start doing the pre-gaming of like, yeah, if I work for a company, maybe I got to worry if they start reducing their workforce because they're going into retrenchment mode. If I'm an investor, do I have to say, the beatings may likely continue here for a good long while because this isn't something that's going to get resolved quickly?
Well, it'd be nice to get a resolution. The problem is that when the resolution rests with one man um, who's governing through executive order and pushing the envelope, it's really difficult. I mean, I would just recommend to everybody who's watching this webcast is focus on liquidity. Focus on liquidity. Be liquid as possible. That is the same as Jay Powell standing in the dark room. You want to make sure you have liquidity. And we don't know how long this is going to last. We can go back to, what happened in 1980. Finally, OPEC stopped raising oil prices, and a decade of sclerosis and perennial recession ended. Back in 1990, 91, that recession ended. We finally created a way to resolve the savings and loan crisis through resolution trust and mopped up all the bad assets and created a bad bank. What happened in the great financial crisis is we finally figured out that we had an insolvency crisis on our hands. And so it wasn't just about what the Fed did, it's really what saved the system was TARP. So you can point to every period of crisis and find, with the benefit of hindsight, what the catalyst was. Well, what's the catalyst going to be this time? And we're in a bit of a catch-22. We're in a catch-22 because we know that President Trump, in his heart of hearts, thinks the rest of the world has ripped off America for decades. He treats tariffs as though it's a religion. We know in his heart of hearts that he wants all the bilateral surpluses. Any country that runs a trade surplus with the United States is a ripoff artist. So we know deep down that's how he feels. So just how far will he back away from that? That would be like, the local rabbi eating a pork chop. I mean, I just don't. I mean, is that really going to happen? This has been something that Donald Trump's been talking about, since the mid to late 1980s. He's going to back away. And he says for a while, well, I'm not going to let the markets push me around. And I guess for a short-term period, they did push him around, but it would take a lot. And at this stage, if he backs down totally, uh, who's going to believe anything that he says going forward? It's going to if he backs away from this, when you consider the people that he has around him that are also very much pro-tariff and anti-globalization, his whole team, even the ones that appear to be pretty normal, like Scott Bessent. But you have Ludnick, and you have Navarro, and you have Hassett, you have Stephen Myron. I mean, the list goes on. His whole team is filled with protectionists who believe to the core that America's been ripped off. I've been saying for a while, how do we square the circle of what American supremacy and the fact that America's also been ripped off at the same time? It doesn't seem to hold together. But I guess that the president would say, well, things would just be so much better if we didn't run trade surpluses, if the rest of the world didn't run trade surpluses. So we know where he stands. And so if you're going to say to me, well, we're going to wait for the day till he finally backs away. So see, I don't believe Xi Jinping is going to blink. Let's just say that now this economic war, has gone to a whole new level with China. Okay. China has been around for 5,000 years. They've had dynasties. They're not a democracy. There's no midterm elections in China next year. Xi Jinping will be there for at least the next 10 years, probably until the day he dies. And I think he's only in his early 70s. So he's not going anywhere. And the one thing we know about China is that they have an incredible capacity to withstand pain. Now, I'm not so sure the typical American really voted for pain of any kind back on November the 5th. They voted for change. Not so sure they voted for pain of any kind. But a trade war, China and the US, China comes out the economic loser, no doubt. But they take a real long-term view, and they can withstand the pain. That's their culture. I don't think pain is America's culture, at least it's not anymore. And they're a culture of shared sacrifice. So I don't know, Xi Jinping is going to blink. I find that hard to believe. I know we want to believe it. And so will Donald Trump blink? And then if Donald Trump does end up blinking, what does that do to his credibility? That's what I'm talking about before. It's really it's hard to handicap, because if his credibility is impaired, that's going to have an impact down ballot into what it means in the House as far as fiscal policy is concerned, because you're going to have a lot of these Republicans are not going to be scared anymore. So you see, you have to draw, Adam, we got to draw like this entire almost like decision tree, all these different arteries that are going to lead to different subplots. So I don't really know. I mean, are we going to have some sort of kumbaya moment? And then the thing is that at this stage, and I'm speaking personally and from somebody who's in the markets, and this is where I think the president has shot himself in the foot, is we reached a stage where we don't know if we can believe what he says anymore. Because what he says on Monday, and then on Wednesday, then on Friday, it's changing all the time. So a lot of this is just don't know what to believe. And so, yeah, I think that, what it means, I'll stem what I said before. We spent a lot of time, we wrote a whole report. Okay, we called it MUGA, Make Uncertainty Great Again. And we modeled uncertainty, and that alone can drain up to 2 percentage points off GDP growth. And I don't know. I like to be in the world of wishful thinking. I don't know what ends this. Because this is politically driven, it'll have to be political change. But even that might not do it, because the power of the presidency is such that you can actually do all this through executive order. I'm saying to you, we wrote that report last year. espousing Donald Trump's economic strategy, okay? But did I know at the time that he's going to invoke this arcane loophole on national emergency measures, not just to deal with fentanyl at the Canadian-Mexican border, but with everybody? A trade surplus with the United States is a national security issue. And as an economist, you're sort of like, okay. But the one thing that leads me to believe is this, and this is where I've lost confidence. I lost confidence on April the 2nd because it showed me that there's a fundamental lack of understanding at the highest level, not just in the White House, but among his economists. Some of them have PhDs from Harvard. I guess that doesn't get you too much anymore. That, we've done this analysis. There's no correlation whatsoever, looking cross-sectional and time series between trade deficits and surpluses and GDP growth. There is no correlation for any country at any time between trade balances and economic well-being. Zero. And when you think about the balance of payments, it's called the balance of payments because it balances. There's a balance of accounts. There's the current account deficit. The US runs a trade deficit and it runs a capital account surplus. So the capital account surplus. Now, it's a whole debate in the academic community about, does the trade deficit drive the capital account surplus, or does the capital account surplus drive the trade deficit? You see, because being the world's reserve currency, it's completely normal and appropriate to be running trade deficits. Because you're the world's reserve currency, you have that level of trust and reliability and credibility that other countries don't have. It is an enormous responsibility, but it comes with a tremendous benefit of having a lower cost of capital and a higher rate of return on assets. That's what drives the capital account surplus. The capital account surplus is derived because of that stability you have by being the world's reserve currency, and because of the lower comparative cost of capital and the higher rate of return on assets. You get more spending and you get more wealth. Well, there's a 95% correlation between imports and spending. So the US imports a lot because it spends a lot, and it spends a lot because it has that natural benefit of having a higher rate of return on assets and a lower cost of capital. That's what it means to be the world's reserve currency. So on April the 2nd, when I look through the whole thing, I'm just saying, is Donald Trump actually telling the world, we don't want to be the world's reserve currency anymore? It's too much of a burden on Main Street. And you start wondering, why has gold been surging? Now, it's leveled off recently because, of course, we got this renewed risk-on trade-on, which is more technical in nature. But that's the hidden message, right? Adam, the hidden message is that being the world's reserve currency has been a burden to middle America. And then you start asking yourself all sorts of other questions. But April 2nd was a very big day. I said it was Liberation Day. It was a liberation day from sanity, that's for sure. But that was the day where I put out a report saying, for the first time in my professional life, I've been doing this 40 years, I'm questioning the longevity of the US dollar as the world's reserve currency, with nothing apparent to be able to replace it. But that engenders its own level of financial market instability. So I come back for the here and now, and maybe, Adam, for the next few years, no matter what you do as a business or as an investor, make sure you have liquidity. And I'm not going to try and time it because we could be in this for the long haul, okay? Because this is political. This is political. This is not something where we're going to get Congress together. Now, it took them twice. Remember, Hank Paulson had to kneel down in front of Nancy Pelosi, but we finally did the right thing. TARP was legislated in Congress.
Yep.
This is something totally different.
Okay, so look, the things that I think through your eyes we can have the greatest confidence in is that uncertainty and loss of confidence are going to dominate until and unless we get to some period of time where we can feel more optimistic about things. And therefore, to your point, focus on liquidity, right? Basically, kind of play defense. You know, you're in that dark room with furniture you can't see, so just keep it real safe. So, for people that have to, manage their financial lives here, does that just mean stay in cash and short-term T-bills? Does gold still look like a safe asset going forward from here, despite its pretty dramatic run-up in the near term? If you think the economy is going to continue to slow because of this slowdown in capital investment and household spending, does that have impacts for future bond yields? And what do you think about the long bond? How would you play this world of prioritizing liquidity?
Well, okay, let's unpack that. I do think that you want to have a nice stash of cash, especially since cash is giving you a yield. I'm not going to go into percentages, but I'll say how I'm investing.
Sure.
I think that I want to be very thematic in my investing. Uh, the world is a troubled world geopolitically. Military spending is going up everywhere. I think I'd want to buy a global aerospace defense ETF. You're seeing defense spending going up, not just in China, by the way, and in the US, but also in former pacifist countries like Japan. And look what's happening in Germany now. Germany has broken the fiscal tourniquet,
Yep.
and they're not just doing aerospace defense, but also doing capital goods and infrastructure. So, aerospace defense, cash, aerospace defense. Uh, I do think that interest rates are going to come down. Now, I would say that because of the fiscal uncertainty and the inflation uncertainty, the long end of the curve will come down by less than it normally would. But bonds do tend to make you money in recessions. You're positive, you get a positive total return at the long end of the curve or the 10-year part of the curve. Maybe you want to be in the 5 to 10-year part of the curve if you don't want to, if you're worried about the fiscal premium. I understand that. But in recessions, and even in the recessions of the 1970s when we had stagflation, bonds did not lose you money, but equities as an asset class lost you money. So I do like treasuries. I do like cash, aerospace defense. I think that Juby's talked about the Canadian election to start this thing off. Well, Canada, one of the ways Canada's going to fight back is not through tit for tat tariffs, because that's not going to work in Canada, but through endogenous growth. And a lot of that is going to include pipelines. So Canadian pipelines, Canadian utilities, those will and with a very cheap Canadian dollar for your U.S. investors on the line, you should be taking a look. And there's plays you can make. There's ETFs, but dividend growth, dividend yield in the pipelines and utility space, they are screening very well to us. I'd say in terms of currencies, uh, there's no such thing in our business as a no-brainer, but this is the closest thing, and it's the Japanese yen. Uh, the Japanese yen is ridiculously undervalued. The BOJ has been the deer in the headlights because of this tariff war, but inflation pressures are building in Japan in a very significant way. And the BOJ is going to be forced to raise interest rates, and the yen is going to be forced to appreciate. So I think it's going to go to 120, 130. I think you have 10 to 20%. You can make equity market returns just owning the Japanese yen. And that was actually my last major trade. My last major trade personally was buying Japanese yen naked long. It is stupid cheap
Wow.
to the point of we're talking three standard when somebody says three SDs, three standard deviations, okay. And if you look at the historical chart of the Japanese yen, you want to buy it at 150 and then get out at 120. And we're just in the early stages of a renewed bull market in the Japanese yen. No equity risk, no duration risk. Are you taking currency risk? Sure, currency risk in a 3 standard deviation cheap currency. I will take that all day long. And I think gold, 100%, the tailwinds for gold are in place. I think right now it's in consolidation mode. I mean, up until last week, it was up 30% for the year. I wouldn't be surprised to see a give back. I think the give back is going to give you an opportunity, if you miss the train the first time, to get into the gold, not just gold, but the gold mining stocks. The gold mining stocks, the mining stocks, Anna, just to play catch up to gold, to the underlying commodity, would have to double from here. We actually have done a lot of technical work on gold, and we think in the next 3 to 5 years, it's going to go to $6,000 an ounce.
Wow.
And that's just mirroring previous secular bull markets in gold. Nothing untoward here. But the gold mining stocks is, I think, where the really big money is going to be. And of course, poor man's gold is silver. Silver's got more industrial characteristics to it, but silver's lagged behind. I think silver and the silver miners, I would be gravitating into those as well. And there you have a nice, tight, diversified, not overly complicated portfolio. And that's basically what my asset mix looks like right now.
Gosh, thank you for being so transparent about that. And you kept hitting the subcategories I was going to ask you about. So thank you for anticipating my questions here. David, this has just been fantastic. We're getting near the hour, so I'm going to have to start to bring it to a close. First and foremost, most important question. For folks that have really enjoyed this discussion and are very appreciative of the detail you just shared with us on the different assets that you favor given this environment, where can they follow you in your work between now and the next time you appear on this channel?
Great. Well, thanks for asking, Adam. So, a couple of ways. You can just Google Rosenberg Research and go right on to the website, or information at rosenbergresearch.com, and you can get a free trial of my research. My is it still called Twitter? It's called X. It's a Econ Guy Rosie. Or you can just email me directly. I was brought up by Depression era parents, so I get back to everybody. I clean out my inbox every
Oh my
day.
goodness.
So here it goes. I won't give you my phone number, but the email is drosenberg@rosenbergresearch.com, and I'd love to hear from you.
Wow, that is so generous of you. I am going to send some flowers in memory of your email inbox. It's going to get exploded now, but that's very kind of you to offer that to folks. And David, when I edit this, I will put up the links and URLs, et cetera, to everything you mentioned there, so folks know exactly where to go. Folks will also be in the description below this video, so you can get there with one click.
Right.
All right. Well, look, I want to give you the last word. Hold on just for 2 seconds. I've got some quick housekeeping to do. First off, folks, if you have enjoyed this conversation with David as much as I have and really want to show him appreciation for being so transparent again about the specific assets and what he thinks about them, please show that appreciation by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Obviously, if you want to get more detail about David's work, definitely reach out to any and all of those resources he just mentioned. If you're looking to get some help in just figuring out how to navigate this quite volatile road ahead, it seems like we're going to have both in the economy and likely in the markets, as David has laid out for us. I highly recommend that most people watching this video get that help from a good professional financial advisor, and importantly, one that takes into account and understands all the macro issues that David's been talking about here. If you've got a good one who's guiding you through that, great, stick with them. But if you don't have one, or would just like a second opinion from one who does meet those criteria, then consider scheduling a free consultation with one of the financial advisory firms that Thoughtful Money endorses. We've got firms in the US. We also have firms in Canada too. To set up one of those free consultations, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds. These consultations, as I said, are totally free. You'll get personalized guidance. Then you can choose to do what you want to do with that. All right, David, look, thanks so much for your patience. I'd love to just let you give the last word to folks here. Like I said, we do have professional investors that watch this channel, but it's largely just regular retail investors just trying to prudently grow and protect their wealth. Obviously, probably quite very concerned about where things might be headed, especially listening to your commentary here. Any bits of parting advice for that person?
Yes, and it's just going to be a reiteration of my overall theme, which is how to deal with your business and your finances in a super elevated state of uncertainty, which is unlikely to be resolved anytime soon. So I would say that whatever your bands of risk tolerance are, know those bands and de-risk as much as you possibly can. Uh, and as I said before, most important thing, be liquid. Be liquid. Uh, if I'm right that we're finally going to get the recession that never came in 2022 and 2023, the financial markets across the board are only priced. I mean, they've done some work, but they're only priced 25% of the way for a recession. And I think that we're going to be getting an economic recession. I know that it's the boy who cried wolf, but remember that the wolf shows up at the end of the story. Have the liquidity. Have the liquidity so that when the assets get transferred from the weak hands to the strong hands, that you're one of the ones that has the strong hands.
Very well said, David. Thank you, my friend. Great discussion as always. And good luck to your country today, however the election goes. I do want to say, just speaking on behalf of my countrymen here, hopefully when the dust settles from all of this, there's a way for us folks, Americans here, to make repair with our good brothers and sisters up there in Canada. And we would very much like to be stepping into the future even closer with you guys than we've been in the past. So hopefully we can make that happen.
Amen to that.
All right, my friend. Thanks so much, David, and everybody else. Thanks so much for watching.